Inf Inflation is not gone, and capital already knows it. Before headlines change, before economists revise their forecasts, portfolio balance testing. Inflation is not gone. Capital already knows it. Money moves before headline, before economists, before portfolios are rebalanced. And this chart you're looking at right now is not forecasting inflation. It is confirming a rotation that is already underway. Forget fear, forget speculation, forget about regime recognition. On that screen, you are looking at the Inflation Beneficiaries ETF, INFL. This is a rules-based basket designed to benefit from inflationary environments, typically including exposure to energy, infrastructure, materials, real asset-linked equities, price power dominant cash flow businesses. This is not retail momentum. This is a macro positioning, and price is telling you something extremely important. So let's walk through this thing very slowly and visually, because this is where most people get it wrong. On the x-axis, what do we have? Well, the x-axis runs from late 2024 to early 2026. This matters because it covers the post-rate hike digestion, the post-rate hike. Remember that? When the Biden administration took a little bit too long to raise rates. Disinflation optimism, and now renewed inflation pressure. Why inflation pressure? Need I remind you that the 10-year yield is above the risk, the Fed fund rate. That usually doesn't happen, meaning they don't trust the Fed anymore. So you're looking at a process here. On the y-axis, you're looking at the price, from mid-30s, early 40s and beyond. Prices is a final arbiter, not CPI, not press conferences. Okay. The large green cup formation. This is the most important structural feature on the chart. The long green curve represents a multi-month basis pattern, often called by its a rounded bottom or an accumulation cup. What does this tell you? Well, it tells you weak hands exited early, capital accumulated quietly, and volatility expressed was the volatility was compressed. You're looking at an ETF, an exchange traded fund that captures everything there is to do with inflation. So this is institutional behavior, not retail chasing. Look at the horizontal resistance line. Notice that the flat white resistance line near the prior high. This is where INFL previously failed. This is where sellers once dominated. Markets remember these levels. When price returns here after a long base, it answers a single question: are sellers still there? And the breakout and the red arrows highlights failed prior breakout. This matters because they shake out impatient buyers, they discourage trend followers, and they reset positioning. By the time the real breakout happens, participation is thin and conviction is strong. So basically, what you're seeing, they are investing in inflationary beneficiaries, i.e., companies that will benefit from inflation because they believe that inflation is on its way back. And that's potentially a bad sign because you cannot have inflation and low rates. The right side cup and the break to all-time high. Now look at the right side of the chart. A smaller, tighter cup forms near the highs. This is a classic trend continuation behavior. Then price breaks out, not marginally, but decisively, all-time highs. Markets do not make new highs in assets that investors do not believe in. Why this signal matters? Here's a mistake most investors make. They treat inflation as a number, not a system. Inflation is not just CPI. It is labor bargaining power, energy volatility, geopolitical fragmentation, reshoring costs, fiscal dominance, capital scarcity, and in an inflationary regime, growth stocks lose valuation leverage. Their margins compress unevenly. Real assets regain relevance. Pricing power becomes king. This chart is capital saying the low inflation, long duration regime is no longer the dominant assumption. So why this is happening quietly? Notice that there's no panic, no volatility spikes, no policy shock. This is precisely when rotations begin. The most important asset reallocation happen when narratives are stale, when volatility is low, and when consensus is comfortable. The INFL breaking out before inflation panic is the tell. You haven't heard about inflation panic, right? It's coming. This chart is not telling you to sell everything. It's saying rebalance your assumptions. Historically, when inflation beneficiaries lead, value outperforms growth, commodities outperform duration, and cash flows beat promises. Real assets regain strategic importance. Ignoring this rotation is not conservative, it is exposed. Every major macro regime shift begins the same way. Price moves first, narratives follow, portfolios adjust last. This chart is not loud, it is not emotional, it is discipline, and it is telling you money is already rotating into inflationary assets, meaning they're going to benefit from inflation. The only question is whether you recognize it in time. Simple warning. When investor sentiment reaches extremes, markets do not reward consensus, they punish it. What you're looking at on this chart is not noise, it is a short-term trading signal. Not. It is a 2-decade psychological map of global capital. And it is flashing a signal that historically appears only at inflection points. This chart comes from the Bank of America Global Fund Manager Survey, and it tracks one thing above all else. Well, where professional investors sit emotionally and positionally relative to history. So let's slow this down and read this very carefully. On the horizontal axis, it is time, as usual, starting in 2001 and extending to 2026. The vertical axis is a percentile ranking from 1 to 10, not absolute optimism, but how extreme sentiment is compared to its own history. The composite line blends 3 inputs: growth expectation, cash allocation, and equity allocations. In plain English, high readings basically mean fund managers are all in, optimists, underweighting cash and overweight risk. And a low reading means fear, capital preservation, elevated cash, defensive posture. This is positioning psychology, not price. And that distinction matters. Now look at the annotations. Every major political shock or financial crisis is marked, and the pattern is consistent. 9/11, Iraq War, global financial crisis, trade wars, COVID. Notice something critical. Look at the extreme optimism does not precede long period of stability. It precedes vulnerability. Each time this indicator presses toward the upper end of the range, future returns compress and shock sensitivity increases. Look at it. Right? Look what happens to the tax cuts, the BRICS, QI, the blue waves, and where we are now. This is not about timing tops, it's about fragility. So now direct your attention to the far right. Look at January 2026. Sentiment is pressing back toward the upper historical percentile once again. But this time is different in a way that should concern every serious investor. Why? Because this optimism is not emerging from balance sheet repair or productivity revolution. It is emerging alongside elevated rates, record fiscal deficit, geopolitical fragmentation, supply chain weaponization, and political regime uncertainty. In other words, confidence is rising while structural risk is unresolved. This is the definition of a late cycle condition. Historically, the most dangerous market moments are not panic lows, they are narratives highs, meaning that this chart shows optimism surging around quantitative easing, tax cuts, political waves, policy promises, trade realignment, but optimism driven by expectation, not cash flow, is fragile. Markets don't fail because people are pessimistic. Market fails because everyone believed the same optimistic story at the same time. This is when diversification fails. If you have a low correlation, if you have a high correlation in your portfolio, that is not good. That is when correlation spikes. That is not good. Everybody's going is hedged the same way. That is when liquidity disappears. This chart is not telling you to sell everything. It's telling you to stop assuming smooth outcomes. Historically, periods like this demand low leverage, high quality balance sheet, real diversification, optionality over precision. This mistake investor makes is thinking that sentiment extremes mark opportunity. They do not. They mark asymmetry. Upside becomes incremental, downside becomes discontinuous. So the core message is this. High confidence does not mean high certainty. It means crowded trades, narrow leadership, low margin for error, and this chart is not predicting a crash. It's warning that the system is less forgiving than investors believe. History does not repeat, but investor psychology absolutely rhymes. And right now, psychology is stretched. When this indicator has been here before, markets did not collapse immediately. They lost resilience. And when the next shock arrived, whatever that form it took, the reaction was violent. The question is not if uncertainty returns. The question is whether portfolios are built for it.